All right, folks, want to provide an update on the liquidity crisis. We're going to be giving you the update on the reverse carry trade taking place in Japan, what our Federal Reserve has been up to, and some of the measures that they are taking while Powell plays politics. The balance sheet tells us a different story. President Trump and Scott Bessent also working to bring interest rates down. So, how does that play in to the situation when we also are watching the conflict in the Middle East unfolding, not slowing down, and now countries in the Middle East are starting to offload U.S. treasuries as well? It's a flight to liquidity. Where is their safety? Let's try to figure it out together. Appreciate you for stopping by. And if you want to join our community, make sure you subscribe, hit that notification bell. All of our community resources are available at zachrector.com, and we greatly appreciate your support. Let's get right on into it, folks. We got statements coming out today. Japan's top currency diplomat, not going to try to pronounce the name, said that Tokyo needs to take decisive steps if these trends continue. Mamuro also stated that further falls in the currency could justify a near-term interest rate hike, providing additional support to the JPY. That's the currency out of Japan. Quick reminder of what the Japan carry trade is and what the reverse part of the carry trade is. The carry trade has been done over decades. This built out over the past 20, 30 years. While interest rates were low in Japan, you could take out cheap debt denominated in Japanese yen, and then you could go leverage that in U.S. equities, U.S. bonds, in other markets, in crypto, right? You're taking almost cheap or nearly free debt out in Japan, and then you're taking that trade somewhere else. That's the carry trade. The reverse carry trade is when those positions have to be unwound and they no longer can be rolled over to a new position with those same cheap low interest rates because rates are rising in Japan. Not only has the Bank of Japan raised rates for the first time in decades, but we have the bond market sell-off taking place over there with the 10-year, 20, 40-year, all of the Japanese bonds are at levels that we haven't seen since the late 90s. So they're trying to protect their currency while battling inflation. And obviously, the shocks in the Middle East, sending shockwaves over to the oil markets with oil up over $100 per barrel priced in US dollars. We take a look at how it's priced in Japanese yen and the same thing's taking place. It's not sustainable. And so as this conflict in the Middle East continues, this only exacerbates the liquidity crisis that's unfolding, not just in the carry trade, but in a global margin call that's taking place across all markets. Every country, every central bank faces their own unique issue. But here's the US dollar versus Japanese yen pairing chart, which did top out at 160.46 over the weekend and into Monday's open. So this is where the Bank of Japan historically has panicked, is up at that 160 level. We have hit that. Now the 10-year up at 2.36 to close off today is the highest level that we've seen since the late 90s. Same thing on the 20-year, same thing on the 40-year. Obviously, we did pop up here at the beginning of 2026 on those longer duration ones, but we're quickly approaching those levels again. And then on the 10-year, we already broke up to that level higher than where we were at in January as we started off the new year. So, to make matters worse, right, and where this gets interesting, from the U.S. perspective, we're working with the Bank of Japan. Our central bank, their central bank, the Prime Minister of Japan just met with President Trump. We're working together to unwind the carry trade gradually, slowly, and safely. Kind of like the Fed was trying to achieve the soft landing. And the question is, will we be able to? The United States has a concern that Japan's going to have to unload all of their U.S. treasuries. Not all of them, but they're going to have to offload U.S. treasuries to shore up their own currency and to get liquidity. That's the threat to the United States of America from Japan. To make matters worse, we're seeing countries in the Middle East start to offload our treasuries as well. Take a look at this article from MarketWatch today. This is a reason the Middle East's major oil-producing countries have been selling their U.S. treasuries. A need for liquidity may be playing a role in the decision of some countries to reduce their holdings of U.S. government debt. Now, this is a $30.6 trillion treasury market for U.S. government debt. And it's supposed to be the safe haven during uncertainty, but it hasn't been because foreign holders of these treasuries are offloading. That is happening. Custody holdings declined 15 billion on the week. But we also just have a more general flight to liquidity or demand for liquidity. So we have, this is Thomas Simmons, who is a market economist for Jefferies in New York, says, as we've seen over the last couple of years, there's been wavering confidence that demand will persist in the long run, causing the market to sell off. Now, he does note that the recent spike in yields has less to do with foreign investors selling treasuries, and it's more about a lot of uncertainty in risk markets and a demand for liquidity. Well, both of those are a problem for U.S. treasuries and for President Trump and Scott Bessent trying to bring rates down. It's both. It's foreign holders like central banks and governments, sovereign wealth funds, etc., offloading and selling U.S. treasuries. But it's also, more broadly speaking, hedge funds, not only in the U.S., but across the world, having to get liquidity. And what's, one of the best sources of liquidity right now is U.S. treasuries. There's enough demand, and there always is, good liquidity for it right now. Historically, at least, there always is good liquidity. But what we're starting to see is that the demand for treasuries based off of uncertainty in risk markets and the war is not enough to cover the selling that's taking place by somebody. So we can let economists debate all day long. Is it a bigger driver of foreign holders selling it off? Is it a bigger driver, the worries about a risk-off environment because of the war? All of it combined is leading to a sell-off in the U.S. Treasury market. Now, at the same time, the Federal Reserve is trying to do their part to soak up and to answer the problem that we now face, which is the sell-off in these treasuries, specifically T-bills, which are short duration treasuries. When you look at the balance sheet of the Fed, not only has the sell-off of these treasuries stopped, it's now increasing. And it's now increasing to a level that we haven't seen. It's actually higher than the levels that we saw after 2020 in the liquidity crisis and the simulation event that we went through during that time. Here's the chart that I shared right here. And it shows us that we're at a level that's about 17% higher than after 2020, or 55 billion higher. And this quantitative tightening did happen through the tail end of 2022, 23, 24. It stopped, flatlined, and then after that pause in the balance sheet reduction, now the balance sheet explodes again, nearly doubles by 185 billion to now 381 billion in short-term T-bills that the Federal Reserve has put on their balance sheet here. So they are doing their part to shore this thing up. And what does this mean for us as investors? It means another wave of inflation, and it means another wave of stimulus and liquidity is on the way. Problem, reaction, solution. And President Trump, this is two birds, one stone. He gets to open up the Strait of Hormuz, right? And it's going to take a big escalation, big troops, maybe troops on the ground, going to take some big movement. We need to open back up the strait. But President Trump also needs to be able to declare victory on this military operation by the midterms, and he also needs to bring interest rates down. And so maybe, just maybe, that escalation that's about to take place in the Middle East will be enough to drive down the interest rates and the yields, because he's going to create that flight to safety. Right? While he's talking about peace on one end, negotiations are going great. Iran is saying that during the 31 days of war, we haven't had any negotiations with the other side. And while President Trump's talking about peace on one side and great deals getting done, we just saw another round of escalation over the weekend. Like I said, kind of plays into what we're trying to achieve, the United States, President Trump and Scott Bessent are trying to achieve by, one, taking control of the Strait of Hormuz, and two, being able to claim victory in this military operation. But then also they're trying to, they don't care about sacrificing the stock market. They don't care about sacrificing some of these markets. The private credit crisis blowing up, etc. They're willing to sacrifice that to bring interest rates down. And it all feeds into this liquidity crisis and a demand for liquidity that has resulted in the selling off of not just the U.S. government bonds, but Japanese. Look at the British bond market. Look at the German bonds. Same thing's taking place across the board. And we are now starting to see, Powell is playing politics, and I retweeted these statements from Jerome Powell saying that it will not end well if we don't do something fairly soon in regards to the U.S. national debt. And I said, Powell is playing politics while they add more T-bills to their balance sheet than they did during the simulation of 2020. So they're not willing, Powell's not willing to come out and say that this is bad. We're here taking measures. We've added more T-bills to our balance sheet than during 2020. He's not admitting that. He's not admitting that it's time for emergency measures and emergency liquidity. Other governments are. This is the Executive Council in Dubai, and they've approved a $1 billion support package for Dubai's business sector to be rolled out from April 1st over the next 3 to 6 months. As I said, there are some governments that are already at panic levels. There's already some central banks that are already at panic levels. Whether or not they put out the press release, whether or not Jerome Powell puts on a purple tie, the numbers don't lie. And so emergency measures from governments in the Middle East, additional liquidity while they sell off U.S. treasuries. Maybe that's how they can fund programs like this, right? They're selling off U.S. treasuries to shore up and to save the day in their own country. Same thing taking place in Japan. And we're trying to slow that down. We can't have Japan and others selling off these treasuries too quickly, or it leads to our interest rates going up, working against the objective of President Trump and Scott Bessent. Please note, I'm not here to talk politics. I'm commenting on the objectives of each party involved in this scenario and situation in front of us. I'm not here to say left, right, up, down, what's right, what's wrong, who goes to heaven, who goes to hell. I'm here to say this is what this party is trying to achieve. And because of these actions, it will lead to this result. What's the result going to be? Massive emergency measures for liquidity and stimulus from central banks and governments around the world to save the day from this global margin call. The reverse carry trade is at panic intervention levels for the Bank of Japan over there. We're at emergency levels. And when we look at the balance sheet of the Federal Reserve, it's telling us the story. See, the liquidity crisis was unfolding in 2019 before the events of 2020 took place. That just happened to be the cover. See, all of this was taking place before President Trump announced the tariffs to bring down interest rates last year in 2025. Before we launched the military operation to achieve a couple of objectives, but also at the same time, bringing down interest rates by driving demand for treasuries because you scare the ever-living you-know-what out of the rest of the world. The double side of that sword is they might have to sell off your treasuries, especially your longer duration ones, so that they can get liquidity now. It's a fine needle to thread. Just like the Federal Reserve trying to achieve a soft landing. It's a difficult task. I'm not saying that we're going to be successful in it. I'm just outlining what needs to be done for these parties to achieve their objectives. And what it means for us as investors is we got to own hard assets that don't have counterparty risk and get us away from this system and can be a store of value and something, an asset, a commodity that can be trusted and used by all of the involved parties in this equation. Japan, the UK, the United States, Middle East. What do we all respect? Gold, silver, and commodities. The energy sector is going crazy right now too. The great plays in the energy sector. I am betting on President Trump finishing up this military operation, or at least declaring victory by the midterms, and also the escalations in the Middle East that it will take to achieve that victory lead to interest rates going down, in combination with the new Fed chair, Kevin Warsh, lowering interest rates as well. On top of that, new waves of liquidity and stimulus injection through various forms we're already seeing to the business sector in Dubai over the next 3 to 6 months. We have $1 billion. That's the first commitment. You're already seeing our Federal Reserve, what they're doing with their balance sheet. All of this leads to another round of inflation. Be prepared for that. Your groceries and everything else are not going to get cheaper, at least not short term. But it also leads to another massive rally, just like we saw after 2020. They're going to turn those money printers on. They have to come save the day. And it's going to save our portfolios because it's going to lead to another round of asset appreciation, and you do not want to get left behind. Now, let me know in the comments down below what you think the best plays are for this scenario that I'm outlining, because I'm looking for alpha. Obviously, we love XRP. We love our digital assets. We love precious metals. The energy sector is looking fantastic right now. But let me know where you guys are finding alpha in the comments down below, how you are positioning for this scenario unfolding. If you need a platform that can help you get exposure to precious metals or digital assets in your retirement accounts, we have our sponsor, iTrust Capital. They are linked up down below. And when you use my link, you can also get a $100 funding bonus. Roll over that 401k today. You don't got to wait. You can get it done today. Buy and sell crypto, gold, and silver 24/7, 365 with low costs, no monthly fees, 0 fees on the institutional grade custody. Absolutely love it. Use my link to get a $100 funding bonus, but please prepare yourself accordingly for what's about to unfold here in 2026. Let me know what you agree with, what you disagree with. I'm excited to read all of your guys' comments, and I always appreciate your feedback. If you appreciate what we're doing, please help us out by liking this video, sharing it out far and wide. Everything else is at my website, zachrector.com. I am your host, Zach Rector. I really appreciate all of the love and support. If you want to support the channel, just remember that you can start by smashing that thumbs up for me, sharing this content far and wide, and everything else is at my website.